I'll call together the May 2nd meeting of the Santa Barbara City Finance Committee meeting. And we have two items on the agenda. The first item is the General Fund Major Revenues and Multi-Year Forecast. Mr. Samario?
Thank you, Mr. Chair, members of the committee. So this is the first in a series of presentations we'll make to the Finance Committee in connection with the recent filing of the two-year financial plan for 2018 and 19. And we usually start in the first presentation covering our assumptions related to our revenues, the general fund revenues, and these are the non-departmental revenues, essentially taxes and the like. And then I will follow that up with Ms. Nemes' presentation with a look on how those numbers play out over a longer period of time. So the two-year plan, of course, covers 2 years, and I've got a multi-year forecast that goes all the way to 2021 to see how that shapes up, in terms of how the lines are going between revenues and expenditures over a 5-year period. So with that, I'll turn it over to Ms. Nemes, Julie Nemes. She's our Treasury Manager, and she'll start with the general fund revenues.
Thank you, Mr. Samario. Good afternoon, Chair Hart, committee members. I am Julie Nemes, the Treasury Manager, and I will be presenting the General Fund Major Revenues for fiscal year 2018 and 2019. I'll be going over several different areas. First, I'll be covering a summary of the non-departmental revenues. After that, I'll be going into some details on the separate revenue categories. First of all, going into sales tax, then property taxes, transit occupancy taxes, utility users tax, franchise fees, business license, and finally, property transfer tax. This first chart is a summary of the non-departmental revenues. In the first column, the yellow, is the fiscal year 2016 actual results. In the orange is the fiscal year 2017 current year. We have the adopted budget, the revised projections, the variance between our revised projection and the adopted budget. In the green is the FY18 proposed budget and the growth assumption. And the blue is the FY19 proposed budget and the growth assumption. You'll see for FY16, total revenues, actual revenues, were $83 million. In orange, the adopted budget originally was $86 million. However, based on current results to date and some other data that we have, we did a revised projection, and we believe that the reforecast will come out to about $85 million. This results in a variance to adopted budget of about $1.5 million, and that's the number I highlighted or I circled there at about $1.5 million negative, the variance between adopted and the revised projection. For FY18, we are proposing a budget of about $88 million. The growth rate is $3.7 million. I did want to also point out that we have a growth rate of 25.8% for franchise fees. I wanted to point that out because it's a large growth rate. I'll be going into detail later in the presentation about that, but that really is due to the 1% SCE franchise fee that we put back into the budget this year. We took it out in FY17 due to the litigation, and we put it back into the budget. But I'll go into a little more detail later. For FY18, we are assuming a growth rate overall for all of the revenues of 3.7%. That's down at the bottom of the green column. In total, the proposed budget is about $87.9 million, as I mentioned. For FY19, we're proposing a growth rate of 3.2% overall, and that does equate to about $90.7 million. I'll now go into detail for each of these revenue categories. For sales taxes for FY17, we do have a lower base in FY17, and that's due to reduced returns in the final quarters of FY16. Sales taxes are received quarterly, and we get them 1 quarter in arrears. So when we did adopt the budget for FY17, we only had 2 quarters at the time. So we received 2 final quarters for FY16, and we have received 2 quarters to date. So we have a lower base going into FY17, and then we also have received 2 quarters for FY17 that were lower than we anticipated. So we have reduced our growth rate that was originally adopted at 3% down to 2% for the remaining 2 quarters. The 2 quarters so far for FY17 came in at 2% and a negative 1.3%, as opposed to the 3% we had adopted, the growth rate we had adopted. This results in a projected revenue decrease of about $626,000 for FY17. Our assumptions for FY18, we are proposing a growth rate of 1.5%. That is a lower growth rate than what we adopted in FY17, and we revised 3% down to 2%, and that's due to the lower quarterly returns we've seen for the last 4 quarters. Also, we are including an impact of recent store closures. For example, Macy's was one of the stores that has recently closed. This results in a net growth rate of 1% for FY18. Also, for FY19, we are proposing a growth rate slightly higher than 1.5% to 2%. We think that there's the potential for new businesses because of some of these closures. There could be new businesses that come back online. Also, we are seeing inflation slightly higher. We're seeing it reach close to 2%. It could go even higher than that. So we think there is the potential for sales tax to increase in FY19 in the outer years. So how does this look looking at all the years for sales tax? This chart gives you a good idea of 16 all the way through 19. So FY16, we had a total of about $21 million in sales tax. Those are actuals. For FY17, we did adopt a budget of about $22.3 million. The shaded areas in 17, 18, and 19, those are forecasted results, whereas the white is actuals. So you can see where we had the adopted growth rate in green of 3% for FY17, and we reduced that to 2% for the remainder of the year. It results in a net growth rate for FY17 of about 1%. For FY18, we did adopt that 1.5% growth rate, but with the impact of additional of the store closures, it results in a net growth rate for FY18 of 1%. And FY19, the 2% growth rate results in a proposed budget of about $22.3 million, FY18, $21.9 million in total sales tax revenues. This next chart is a historical look at sales taxes from 2011 through 2019. In 2011, the city received about 17.6 million in sales taxes. In 2016, which was about a 0% growth, just slightly down, a negative 1.1% growth rate in 2016. The city received 21.5 million in sales taxes, and the green bars represent our forecast. So in 2019, we are forecasting to receive 22.4 million in sales taxes. That results between 2011 to 2019, a difference between 17.6 million and 22.4 million is an increase of 4.8 million over 9 years. The growth rates vary between a slightly negative 0.1% to 8.8% over those 9 years. And between 2011 and 2015, the average growth rate was about 5.2%. So what you'll notice is in the last couple of years, the growth rate really has dropped off. And this is what we're seeing this really is mirroring what we're seeing in the economy. We're seeing less retail sales, more internet sales. We're seeing that move away from goods to more service industries. So we really are going to probably and Mr. Samario is going to go into the multi-year forecast, but we really are not seeing those large increases, percentage growth in sales tax like we saw many years ago. Moving on to property taxes for fiscal year 17, this is this is probably our strongest revenue right now. Over the last couple of years, property taxes have really performed better than anticipated. For FY17, the city, we did adopt a growth rate of 5%, and we actually received the county valuation reports with assessed values of 5.5%, so it's performing better than we anticipated. And we are projecting a revenue increase of about $121,000 for the current year. For fiscal year 18 and 19, we're proposing growth rates of 5.5% for 18 and 5% for fiscal year 19. In those figures, we are assuming about 2 to 3% in annual growth from ownership transfers from sales. We are seeing both nationally and locally strong housing, both turnover and pricing. We're seeing a lower inventory and quick turnover. We also confirmed that with our property tax consultant. We had a 1-year contract with a property tax consultant, and she saw the same turnover, the good housing economy, the low inventory, stronger housing pricing, quick turnover. I also wanted to point out that we continue to see Proposition 8 recapture. This is when properties were reduced by the assessor's office several years ago with the housing crisis, and the assessor continues to be able to recapture that value. We have about a little over 1,000 properties that still have value that the assessor can recapture. And we believe it could end in fiscal year 19 or 20. We're not sure yet, but it's over $300 million in value that is still available for recapture. So we have estimated between 0.5% and 1% each year in recapture that is built into those rates.
Councilmember White?
Thank you for that. What's the total value?
In all assessed values?
Yes.
I believe it's 14 trillion.
14
I have
trillion.
a report with
That
me,
doesn't
actually.
Doesn't seem right. 14 billion?
Fast for me.
Too many zeros.
Yeah.
No, I think it's 14 billion. You're right. Excuse me. It is 14.5 billion. 14.5 billion.
Okay, thank you. First time I've heard that number. That's
Yeah, me too.
At one too many zero, or we would be able to rely just on property taxes. Thank you. This chart is representative of our property tax revenues. It's very similar to the prior chart that I presented for sales tax revenues. As I mentioned, property tax revenues are our strongest revenue source right now. In fiscal year 16, the city received over $29 million in property tax revenues. In fiscal year 17, the city adopted a growth rate of 5%. However, it came in at 5.5%, resulting in a variance to adopted of over $120,000. For fiscal year 18, we are proposing a growth rate of 5.5%, which is the same growth rate we received in fiscal year 17, which results in over $32 million in property tax revenues. For fiscal year 19, we are proposing a growth rate of 5%, just slightly below fiscal year 18. This slightly reduced growth rate also takes into account maybe a reduction in the Prop 8 recapture, and this results in total revenues of over $34 million. A historical look at property taxes from 2011 through 2019. This shows just after the housing crisis in 2011, that was the last year of a reduction in property taxes, the negative 1.1 in 2011. We received over $22.8 million in property taxes in 2011. In 2016, the city received 27.5 in property taxes. Once again, the green are the forecasted numbers, and we are projecting in 2019 to receive $32 million in property taxes. Between 2011 and 2015, the average growth was only 2.5%. However, in the forecasted between 2017 and 2019, it's over 5%. So as you can see, the property tax growth rates have really picked up in the last couple of years. The next revenue I will be covering is transient occupancy taxes. For fiscal year 17, similar to sales taxes, we do have a lower base in 17 due to lower returns in the final months of fiscal year 16. The last 3 months of the year were all negative, negative 5%, negative 3.6%, and negative 0.1%. That does result in a lower base for fiscal year 17 as we adopted the budget prior to those months coming in. This revised projection also is based on actual results through February 2017. Some other assumptions that we took into play when we built the revised projection for fiscal year 17 is that we increased the impact from short-term rental enforcement. Originally, we had built into the fiscal year 17 adopted budget an impact of about $262,000. We originally believed it would take longer for the impact of the short-term rental enforcement, resulting in only about $260,000 in FY17. However, we realized after adopting the budget that all revenues from January on would be lost from short-term rental enforcement, resulting in about $530,000 loss from January on in fiscal year 17. Also, in fiscal year 17, it includes a full year of Santa Barbara Inn. And so all of these changes in FY17 result in a revenue decrease of about $808,000 from adopted budget. For fiscal year 18, we are proposing a growth rate of 3% for existing hotels and motels. We are also proposing a loss of all revenue from short-term vacation rentals, since part of that was already taken into consideration in fiscal year 17, about $560,000. The remaining $700,000 will be taken out in fiscal year 18, about $1.2 million total. Also, we did include La Entrada for the entire fiscal year. For fiscal year 19, we want to continue the 3% proposed growth rate for existing hotels and motels, and we also include a separate additional growth rate for La Entrada. So we do a conservative growth rate for La Entrada, and we believe that they'll pick up additional growth in the second year. Sorry, this is a little bit small, but it's a lot of data to present. This is the transient occupancy tax table for fiscal year 16 through fiscal year 19. In fiscal year 16, total revenues are about $18.5 million. For fiscal year 17, once again, the actuals are in white and the blue are the forecasted results. Based on all of the data I covered in the prior two slides, the original proposed hotel growth rate was 4%, and we had some adjustments for short-term vacation rental and Santa Barbara Inn being online for all of FY17. The net growth rate, revised growth rate, is about 2% for fiscal year 17. All of that does result in a variance to adopted of about $800,000. For FY18, we are proposing a 3% growth rate for the existing hotels and motels. However, we are also realizing a loss of about $700,000 from short-term vacation rental enforcement in FY18, and we also are including La Entrada for the entire year. That results in a net growth rate of about 1.6%. For FY19, we are recommending a 3% growth rate for existing hotels and motels, plus an additional growth for La Entrada. That nets a 3% growth rate for FY19, for total net revenues of about $20 million for FY19. And the total revenues for FY18 are about $19.3 million. Sorry, that's so small. A historical look at TOT revenues from 2011 through 2019. As you might recall, prior to 2016, TOT revenues were one of our strongest revenues. Growth was often in the double digits, as you can see in 2014 and 2015, double-digit growth for both years. And however, in the last couple of years, growth has definitely slowed down. In 2011, total revenues were $12.5 million. In 2015 and 16, total revenues were $18.6 million. We had no growth in 2016. It was actually flat. We are forecasting in 2019 to have total revenues of $20 million. Between 2011 and 2015, the average growth was over 10%. So we had an average growth in the double digits. However, in the last couple of years, the growth is only around 2%. So in terms of the reasons for this, we're not exactly sure. We're not sure if it's due to the strong dollar. We're not sure if 2016 there were some environmental issues that caused that 0% growth. So there could be also, you get to a point where you could be reaching close to full occupancy. There could be a lot of different reasons. So but we do think that the days of potentially double occupancy or double-digit growth, it may not be possible. For utility user tax for FY17, the revised FY17 projection is based on actual results through February 17. The overall growth rate has been reduced from 2.2% to a negative 1.2%, and there's a few reasons for that. There's several individual rates built into the UUT, and all of those growth rates do vary. We are seeing the largest declines in cellular and electric. We continue to see a decline in cellular as consumers move away from the traditional cellular and go towards prepaid cellular. We have started to receive prepaid cellular UUT. We started to see that in FY16. However, it doesn't replace all of the loss in the traditional cellular. As for electric, we saw some one-time credits in the current year that really had a significant impact on our electric UUT. We believe this is a one-time adjustment in the current year, and we don't anticipate to see that next year, but we won't know for sure. In terms of gas and water, those both had the most significant growth, and we revised our projections for both gas and water. We revised gas and water to a 6% growth and water to a 12% growth. In terms of cellular and electric, we revised cellular down to a negative 14% and electric to a negative 10%. All of these changes and assumptions resulted in a decrease of $166,000 compared to adopted budget. For fiscal year 18, we are proposing an overall growth rate of 1.9%. This does assume a continued decline in cellular and telephone. Similar to cellular, we do see consumers moving away from traditional telephone in favor of prepaid cellular. We also see consumers moving away from cable in favor of online services. And we don't receive UUT for online services. We also are assuming growth in all the other categories, with the largest growth rates in electric and water. As I mentioned, we believe the one-time credits in electric are just one time, and we are aware of a 6% increase to SCE in fiscal year 18, and we did budget for that. And water, we are projecting a 7% increase to a 7% increase to water in fiscal year 18. For fiscal year 19, we're proposing an overall growth rate of 0.1%. And this assumes no growth in electric. We're not aware of any increases to electric in fiscal year 19. And we are proposing only a 5% growth rate in water for fiscal year 19. It also continues the decline in cellular, telephone, and cable in FY19. Once again, a table similar to the other ones for fiscal year 16 through 19. As I mentioned, telephone, we do subtotal telephone, which is cellular, VoIP, regular telephone, and prepaid cellular. As I mentioned, cellular, we just started to receive prepaid cellular in fiscal year 16, and 17 was the first year we got a whole year of it. As I mentioned, it also doesn't completely replace what we've been losing in traditional cellular. We continue to see the subtotal of all telephone categories go down, and in fiscal year 17, it is we revised it from a positive increase to a negative growth rate. Overall, we revised our growth to a negative 1.2%, resulting in a variance of $165,000 compared to budget. For fiscal year 18, we are showing a growth rate of 1.9%. This is largely due to the growth in electric and water, as I mentioned earlier, which is partially offset by the cellular, telephone, and the cable negative growth rates. Overall, we are projecting a proposed budget for FY18 of about $7 million. In FY18, it's basically a flat growth rate, so the proposed budget is also $7 million. For franchise fees, the revised FY17 projection is based on actual results through December, as those are received quarterly. The overall growth rate has been reduced from 0.4 to a negative 4.3. Franchise fees follow the same patterns as UUT, so it's also going to be due to the electric and cable, as I mentioned earlier, with UUT. This results in a projected revenue decrease of about $152,000 from budget. The proposed growth rates in FY18, as I mentioned on the very first slide, is about 26%. In fiscal year 17, we actually took out that 1% SCE franchise fee due to litigation. We felt it was best to remove it from the budget, and we had been collecting it but putting it in a liability account. And in FY18, due to the litigation being just about resolved, we felt it was safe to put it back into the budget. And so we have put it back in FY18, and it's also in FY19. So that's why there is such a large percentage increase in FY18 and a zero in FY19. Also, as I mentioned with the UUT, we have a 6% increase in electric just for price increases that SCE has alerted us to in FY18. And the 1% SCE that we've added back in equates to about $702,000. We have done no growth in electric in FY19. For our business license, in FY17, we have done a revised projection based on results through February 2017. And originally, we had adopted 0%. That was largely due to the vacation rental enforcement. We felt that that would impact our business license, and we did not feel that we would project any kind of increase. However, we are seeing an increase in business license just due to normal licensing activity. So we are projecting a revenue increase of about $166,000 for FY17. And based on this increase in licensing activity, we do feel that we should propose a growth rate of 1% both in FY18 and 19. And lastly is property transfer tax. And this is $1.10 for every $1,000 of assessed value. It is very difficult to estimate because it's based on sales activity. One very large purchase can have a significant impact. In July 2015, we had over 100% increase from one purchase. So we do always budget a 3% growth, and we've usually come in very close to that, a little bit above or below. So we recommend no change in 17, 18, or 19, just because it's so difficult to predict. This is just a summary of those last three revenues: franchise fees, business license, and property transfer tax. In total, even though they really don't have anything to do with each other, but in total, they are only within $13,000 of adopted budget. The revised forecast, really looking at them individually makes more sense. So for franchise fees, as I mentioned, they're about $152,000 below budget, and that's largely due to electric. The business license is coming in above budget because we had projected adopted a 0% growth, and we're actually seeing additional business license activity, and property transfer taxes within $1,000. For FY18, for franchise fees, as I mentioned, we added that 1% SCE franchise fee back in. That's the big growth there. And for FY19, we have a 0% for franchise fees. For business license and property transfer tax, 1% for business license and 3% both for property transfer tax. For FY18 and 19, they're within about $30,000 total revenues for all three of these for both years. I thought it might be helpful just to return back to the original revenue summary. I didn't do this last time, but there's so much detail we went through. I thought it might be helpful just to go back and look at all the revenues and see where we started and where we're ending up after reviewing all of that. So for FY16 actuals, we ended up at $82.8 million for all of these revenues. For FY17, originally adopted budget was $86.3. However, with the reforecast, we're ending up at $84.8. For FY18, we're proposing $87.9 with a growth rate of 3.7%. And for FY19, we're proposing $90.7 million with a growth rate of 3.2%. And I'm happy to answer any questions that you have at this time.
Thank you, Ms. News. That was a very comprehensive, detailed, fine-grained report about revenues. I mean, it shows a lot of work goes into these revenue estimates, and they are not just arbitrary percentage COLA-adjusted numbers. They are really under the hood, looking very carefully at them. Are there other questions from other committee members about this? Councilmember Dominguez?
Thank you again. To repeat on my colleague, this is a great report, lots of detail. Thank you for bringing this to us. The question I have is related to property tax, and I guess going up one level in terms of our ability to forecast more long-term and looking at longer-term cycles. It seems like we're really looking at the past couple years in a shorter-term cycle. But I'm just curious, when the property taxes or our property values dropped in the last recession, was there a lag? Do we know like how long a lag would be if things were to flatten out in terms of our property values, or does that keep going because there's a lag in reassessing the properties from the county's point of view?
Do you recall? I wasn't here when they did that. Want to answer that?
Yeah, I'm not sure I have the answer to that question. So prior to the recession of 2008 and 9, we saw somewhere around a 40% decrease in property values. We didn't see a real decline in our revenues. The assessed values went down. But we were enjoying somewhere around 7 to 9% per year growth, and then it flattened out in 1 year, I think right at zero. And then the one that Ms. Nemes showed was a small decrease in 1 year, but then started climbing again. So, that was within a couple of years. So it all happened pretty quickly, but we never saw just because the way the real estate market works, we never saw a decline corresponding to the decline in assessed values, and largely because it depends on how quickly the county is going to reassess values downward, and I'm sure they took some time in doing that, but it was when they did it, they were big numbers, whereas today they're recapturing much more incrementally. So I don't know that there's any sort of way to know what the lag is. It just depends on, in large part, what the county decides to do in reassessing the values, applications for reassessments that are sent in, the degree of drop. So I'm not sure that helps, but I'm not sure I can really give you a definitive answer.
Well, it's helpful to know that there wasn't a big dip, and I think part of that is people are buying new properties, so they're getting reassessed upward quite a bit, even if in the last couple of years the average price has dropped in a community. Someone buys a house that's been owned for 50 years under Prop 13, it's dramatically undervalued. So
That's true.
I think that's the only question I have. Thank you.
Councilmember White?
Thank you. Yeah, that was kind of where I was headed on that question about how many, was it 14 billion? Is that what we ended up with? All right, and then the notion that comes to my mind is how much of that, I know the county, I think the county keeps track of the total appraised value, if I can use that term. They watch the current market value of stuff as one of their tracking numbers, and then they have, of course, their Prop 13 column as well. And I'm imagining there's the difference between those two is at least gives us some sense of, that 14 billion, is it actually worth 28 billion or whatever? So that extra 14 is the Prop 13 damper that unwinds at its pace, and we can. So that's there's probably something in there that would help us understand better. Obviously, it protected us during the crash because we had that huge inventory ongoing of longer-term properties. I remember seeing something interesting, the conversations that we've had over the years about, was it Newport or somewhere like that, where it's such a new city that they don't have that that legacy that we do of very old properties. I've forgotten what it was, a community like that in any case, where it was like, well, it's all been built since 1985 or 90, and so maybe it was Irvine. It might have been Irvine. It was one of those like that we were trying to get a sense of, and that latent value is not there. And of course, we're loaded with latent value here.
I guess that prompts me to ask the question about sales tax revenue in the last recession. How much did that drop?
Yeah, during the Great Recession, I'm going to throw out a number. I think in 1 year, we saw somewhere around a 12% decrease to sales taxes, and another was more like 4 or 5%, but it was pretty dramatic. It was pretty dramatic between sales taxes and our bed taxes. Those two numbers alone caused us somewhere around a $5 to $7 million shortfall. It was a big hit, and again, in 1 year. And you may recall back then, or somebody may recall that we were dealing with a $10 million deficit caused overall by the impacts of the recession. So property tax, again, didn't go down, and that was in the Great Recession. During the earlier recession, property taxes weren't impacted at all. They were still growing at 7% during the impact of 9/11 and all that, where sales tax and bed tax sort of flattened out, but property taxes didn't even hiccup. Anyway.
Thank you.
Chair Hart, I do
Yes.
have that number for you.
Oh, perfect. Maybe
In
I'll see how close I was.
2009, sales tax dropped 11%, which was $2.2 million.
And normally, if I may, that would have gone, we were looking at a 3% rise or whatever our sort of calculated budgeted number going up was
Yep.
3 plus, right? So
Yeah,
you add that in, and that's a 14% delta from what we were.
Yeah, more than that, because we've never really recovered from, when you lower the base to that degree and then you start going to 3-4% again, you're never going to get there. You need 8-9% for many years to get back to where you would have been had you had normal growth and no recession.
And just to chime in one more is that over a 3-year period, it dropped 17%.
That's pretty close.
Well, as I said, you could make a lot of different assumptions going forward about the economic condition of the state and the local economy and the nation and the world. And I think you've done a really good job of finding that balance between being cautiously optimistic but sober about growth and revenue. So I think this is a really quality product. Anything else from anybody else on the committee? Well, thank you for the presentation.
So we're going to move on to the other sort of second half of this.
The long-term.
Which is the multi-year forecast.
Forecast, okay.
And I wanted just to preface it by saying that the goal of the multi-year forecast is not to see how accurate we're going to be with our projections, because we don't know the further we get out. What we're trying to establish is there a structural deficit built into the way our revenues are growing relative to our expenditures that we need to kind of pay attention to, or at least observe, and you only can really see that if you start looking more long term. And more importantly, the only way you can see that is if you kind of hold everything constant. If you assume the same types of growth rate on your revenues and the same types of growth rates on your expenditures, are the lines going further apart? Are they staying together, or are they overlapping? So that's the goal of this, is to show you how those lines are moving over a 5-year period, which includes 17 projected numbers in the 2-year financial plan, and then 2 more years beyond that. So as Ms. Nemes went through her assumptions, I'm going to go quickly through the assumptions that I made, particularly in the 2 out years, because that's where all of this occurs. So for 18 and 19, I went exactly with what the 2-year financial plan, everything that Ms. Nemes just described. For 2020 and 21, I added $1 million in property taxes starting in 2020, and this is because you may recall that with the dissolution of the RDA, we could continue to get revenues from those property taxes, the tax increment, to pay off the debt that is still outstanding on those. There are 2 bonds that were issued in 2001 and 2003, and those will be fully retired by 2019. And that's about $8 million a year. And just like all the RDA money of $20-some million was sort of allocated to the jurisdictions, the school districts, the county, and the city, we get about 13% of that. So we will get 13% of that $8 million that will no longer be needed for debt service, and that's about $1 million. So that's a nice little boon we'll get in 2020, and that'll be ongoing with whatever growth rate occurs. All the other taxes, however, I assume to be the same. So, for example, if we assume sales taxes to be 2% per year in the next couple of years, I assume 2% in the out years. Departmental revenue growth, that's the fees and charges that like planning and building and those folks charge. We historically have tried to raise the rates of the fees themselves to generate somewhere between 0 and 2%. It just depends. The target is closer to 2%, just to keep up with the cost of services that we provide. I've assumed that for the most part they're going to be in the 2% range. Some we can't control. There are some departmental revenues, like mutual aid revenues, we just can't control. So those are probably kept more flat. And then you may recall that in the second year of the 2-year financial plan that we increased our anticipated year-end variance that comes from savings from turnover in staff. It's traditionally been about $2 million. We bumped it this year in 17 by $300,000 as part of our hiring slowdown approach. For 17, because we had a larger gap, for 19, because we had a larger gap, we put it up to $27.7 million. And I thought it was, and again, holding things constant, I thought it was fair to just assume that same number for 20 and 21. Otherwise, you're going to see it distorts sort of the analysis we're trying to accomplish. And then, of course, I don't assume any economic downturn. We are probably in the top 5, if not the top 3, longest expansion period we've seen since World War II. So at some point, we are going to be seeing another recession. Hopefully it's longer, but we're probably somewhere on year 8 or 9, it's a long time. On the expenditure side, as you know, the two-year financial plan assumed salary increases of 1%. It doesn't mean that our labor costs are going up by 1% because it's impacted by benefit costs, and which includes a large part of that is the retirement. And, you know, that's going up, as we've talked about, more than the 1%. So the PERS retirement numbers that I've used are based on what PERS has provided us back in November, as I mentioned before, and I mentioned in the past. They now give us many years of their projections of what we, the city of Santa Barbara, can expect in terms of rate increases based on their assumptions today. And, you know, they're not always exactly right. They're never exactly right, just like with anything, but they've been historically at least in the ballpark. So we're using those for in our two-year financial plan and the multi-year forecast. And then they provided a circular to us back in February or January, February, that gave us a range of what we could expect to see in terms of impacts to our retirement costs from PERS decision to lower the discount rate over a 3-year period, each one of those changes being spread over 5 years, the impacts over 5 years. So it's really a lowering from 7.5% to 7% that's going to be effectively spread over 8 years, from 2019 through 2025. And they gave us ranges of what that impact's going to be. And I just picked the middle number for us. And that's what, in 2019 for us, we're really in the middle of that average, statewide average. It would mean an additional $750,000 in costs on top of what's already been sort of provided for in terms of rate increases over the next 5 years because of changes that PERS made previously. In 2020, that would double. And then in the third year, when they lower the discount rate from 7.25 all the way down to 7, we could expect that first year impact to be in aggregate an impact of $2.5 million. You can see the increment between each of those fiscal years. So 19 we'll see an additional cost of 750 on top of everything else that PERS is planning, 1.5 and then 2.5 in 2021. And I provided 2 versions of my multi-year forecast, which include this last impact, just to see what the impact of these numbers are in terms of the kind of how the lines are behaving. Did I see a question, Jim?
Is it 15 million is what that 750 would be added onto in 19?
Yes. Wow, great memory, great memory. So these numbers here are primarily the amount of money that they're going to be asking us to pay on and added to the unfunded liability portion of our overall rate. Our rate is 2 parts: the normal cost, which is if we had no unfunded liability, this is what it costs to kind of keep up with a funding plan. And then the unfunded liability today is in the order of $14 million. We expect by 19 to be $15 million. So we can expect that $15,750,000 in 2019.
Okay. But our contribution is, what are we expecting our contribution to be in that year?
So again, in dollars or percentage? Or,
dollars, just what is
so
it?
for the unfunded liability piece only, it's $14 million. In total, it's about $20 million out of the general fund.
20 million
So
out of the
about-
general fund.
So most of that, is the unfunded liability. A smaller portion is the normal cost piece.
Okay, thank you.
So this is version 1, which does not include the impacts I just went over with of the lowering of the discount rate. So this version actually doesn't look too bad. One of the things that's helped us in 2020 was adding the $1 million in property taxes, as I described. And so you could see it's really summary information. There's a lot more detail behind this schedule, but I just show one line item, one row for total revenues, and one row for total expenditures, the difference being, of course, the net gain or loss. Below that is, and that's really I break out the capital programs just to see how we do on an operating basis, because, for me, how we balance operationally is important before we decide how we fund our capital program, which is more discretionary. And then below that is the net impact after capital. And then you'll see in column 17, there is a number in that column only that's called the allocation of surplus to capital. You may recall that a couple years ago, we were not sure we were going to be able to maintain our policy reserves based on our projections. And so council at that point directed staff to depart for a couple years from our policy, which says allocate any surplus evenly between capital and policy reserves, and instead shift more to the policy reserves and less to capital, a 75-25 split. So that 492, again, projected numbers, if we in fact achieve that $1.9 million or so net surplus this year, we would then be allocating 25% to capital, the balance would fall to our policy reserves. In 18, obviously, in 19, we are proposing a balanced budget. In 2020, we start to see how these growth rates start to play out in terms of whether we're seeing the lines go apart or stay close together. In 2020, even after covering capital, we are only left with a small deficit of $200,000, which is, in my opinion, you're balanced because there are so many variables to that. It's just kind of noise. But what's a little concerning is in 2021 is that the number gets bigger. It's 1.3 or 1.4 million dollars. So it just means that, and we're talking 1% here, that the lines are slowly, going apart. If you hold all these assumptions constant, 1% increase in salaries, the known rate increases that PERS has given us, or estimates at least, and what the revenue growth would be. When you factor in, however, the impact of the discount rate, then the numbers become a little more dramatic. So in 2019, where the first impact is, you can see the number that I show as the negative numbers is that 750 that I assumed that we're going to expect to see an additional cost. And then really what we're doing is just adding those numbers I presented to the previous version. So the numbers are just more dramatic in terms of how the lines separate. So clearly, we were almost keeping up in terms of our revenue growth with our cost in the previous version, but our revenue growth is not going to be sufficient based on what we are assuming today, what we know today, through 2021 to keep up with the costs when you start factoring in the impacts of the discount rate being lowered. And really that was it. That was the whole point, just to kind of marry the current year assumptions or next year assumptions with what that looks like long term.
Councilmember Dominguez?
So what would the sales tax projection be for 19, 20, and 21? Is that 3% or 2%?
No, we're maintaining it at 2%.
2% the whole time. So if this were to be the set of circumstances that occurred, we would need another revenue source in order to pay those extra pension costs.
We would need to do something to balance. I'm not sure we can generate a new revenue source, but it would likely mean finding a way to control cost to balance.
Any other questions? Thank you very much for that additional information.
Thank you. And I think with that, we'll turn over to the second item. And
I guess before we finish, is there anybody that wanted to speak on this item? Okay, thank you. The next item is discussion about the self-insurance fund, considering revising the procedure for processing of stipulations with a request for award. Mr. Howard.
Good afternoon, Committee Chair and committee members. There it is. Good afternoon, Committee Chair and committee members. We are here to have a discussion about how we process a stipulation with a request for award on an internal basis. And what I'd like to do is provide some background information before we get into the discussion of what is the current process and what we could consider going forward. So by way of background, let's try to understand what we're talking about here. California Labor Code identifies a no-fault system to pay benefits to an employee who sustains an injury during the course and scope of their employment. They factor in two types of benefits into the workers' compensation system. One is medical treatment. That's to relieve and cure the effects of the injury, either on an acute basis, immediately after the injury, and in some minor circumstance, or not minor, but in a small amount of circumstances, on a more chronic basis for those things that need more long-term care. They also envisioned what they call disability payments to cover wage replacement while the employee is recovering from their injury, when they cannot work because of their injury. And that's called a temporary disability benefit. And that's a short-term amount. The second piece is a permanent disability, which is in a small fraction of the injuries reported by employees statewide and even here at the City of Santa Barbara. The permanent disability is a concept of compensation for when the impairment is more long-term, and it's based on the concept of a whole person impairment, or WPI. Is, in the workers' comp system, there are a number of acronyms, and you'll see some of them come up in the presentation. This is the first one. A WPI, or whole person impairment, which is described in a national publication from the American Medical Association on the guides to evaluation of permanent impairment. So it's something that's done by the medical community as a whole on a national basis. The Labor Code, and its citation there for 4658, then establishes a formula for equating that document, multiple pages, into a dollar value. And that dollar value is described both in detail in the code, and it's a function of the code where it combines the doctor's description of the whole person impairment with this rating formula that encompasses both the injury type, the job classification, the age of the employee, and several other factors. It's used by the Department of Industrial Relations Disability Evaluation Unit, or the DEU. They actually take this information, put it into a formula, and come up with what they call a rating, which is expressed as a percentage. And that percentage is then, in the Labor Code, identified by numbers of weeks of disability and a dollar value payment that the employer is obligated to pay over time. And so what we're talking about is, once the physician has determined that an injury has occurred that is covered by the workers' comp system and has resulted in a whole person impairment, and the disability evaluation unit has decided that there is a rateable injury here and has come up with a rating, how do we then agree to make those payments to the employee over an extended period of time? Because many of these might take multiple years to pay out. So the workers' compensation system, through the Department of Insurance, has come up with this form, and you see up there the DWC CA form 10214A, and that's a form that is universally used to identify 3 specific types of benefits: the temporary disability paid while a person was unable to work during the recovery period, if any; the permanent disability value that comes out of that DEU rating percentage; and whether the injury requires ongoing medical care for that chronic phase, if any. And this system uses that form to then describe all those things so the employer and the employee have some finality to that. Now, this stipulation with request for award is not a settlement in the true form of the term defined as society defines it now. Rather, it's a presentation of the findings that in the no-fault system we have met our legal mandated obligations. At this point, the parties, both the employer and the employee, have resolved any disputes about the claim. We've already all agreed that they're eligible to receive the benefits. The DEU, the Disability Evaluation Unit, has issued a permanent disability rating. It is presumed correct. And now the parties are simply seeking confirmation from the Workers' Compensation Appeals Board about the eligibility to pay these benefits, and that the employer has paid all of the legally required benefits to that point. So that's the background information. And now we're going to come to what are we doing currently. So the current procedure requires staff to seek your approval at council before submitting a stipulation with request to award to the Workers' Compensation Appeals Board when the permanent disability value in that rating exceeds $35,000. Now, that's been the procedure since 2005, when the previous city attorney gave us direction saying that he felt that any resolution before the issuance of an order from the court would be considered a settlement. At that point, we changed our procedures to the current one that you are familiar with. In discussions with Ariel Kalan, he and I both agree that that decision was correct at the time, but maybe not the best use of the thinking about mandated benefits. We don't believe it's truly a settlement. This is more of an ability for council to review it, but there's no requirement that you have any oversight to that, because you've already established a workers' compensation self-insurance program. So staff is here thinking that there's a possibility here that we can create some efficiencies to eliminate some delays in providing benefits to our injured workers and just make it a better system. One thing I want to point out is that by adding this added step of council oversight here, we know that at minimum there's going to be a delay of approximately 3 weeks for us to get it scheduled for a council meeting and on the agenda to meet with our Brown Act requirements. We know from practice that the delay is closer to 1 to 2 months in getting those benefits out to the employee. So things to consider, options. Here's 4 options that we've identified as staff that you might want to consider. The first is no change. The second is altering the threshold for your review from the current level of $35,000 or greater to a different amount. There's several options that I can walk you through with that. No review by council for these items at all. Many public agencies don't ask their governing boards to review these types of resolutions. Or the fourth one is no threshold value, but instruct staff, us, to come back to you on a regular basis to give you information about the workers' compensation program as a whole and the aggregate of these resolved claims during that last review period. These are options that you might want to consider, and we're just here to seek your advice as to how you would like us to proceed with these things.
Thank you, Mr. Howard. I think you framed the issues and questions well. I guess just anecdotally, the amounts that we're talking about are much higher than $35,000. So adjusting that threshold to accommodate inflation, since it was last considered more than 10 years ago, even if it was at $50,000, is not going to make an appreciable difference in the frequency that council would be looking at these claims, right?
Chairman, you are correct. If you're asking us for a recommendation by raising the threshold to a different number, I would encourage the council to consider raising the threshold to anything up to 70% permanent disability. At 70% permanent disability, the workers' compensation laws allow for an added benefit to an injured employee. That's called a life pension. That can often equate to 6 figures in additional benefits to the employee. And that might be a different threshold where you'd want to look at. And rather than use a dollar value, use the percentage of disability, because that's not going to change as time progresses with inflation, whereas a dollar value could.
Other thoughts?
Well,
Councilmember White?
Chair, thank you. Just what is staff's recommendations on this?
Chairman and committee member White, my recommendation, if you were to ask me, would be the 4th option up here, is to remove the threshold level and ask us to come back to you maybe on an annual basis and give you an update as to what's transpired in that last period of time. That allows 2 things to happen. We have executive management oversight of the program to make sure that we're doing things appropriately and within your specified guidelines. And 2, it gives you the opportunity to see what's happened periodically and watch the trends and review as to when you really need to see these things. So, over my tenure here at the city, we've done it both ways. Both ways work. It's what works for you as our elected officials.
And you're saying both ways being having the specific amount of money and then work as we do meeting in closed session to discuss to go forward or not, or the no threshold and having a regular report.
Correct.
You've done both of those.
Yes.
Okay. All right.
Councilmember Dominguez?
So I like number 4, except I would change it so that the council did get direct review of maybe the top 2 or 3 cases per year. So that would strike a balance of not having too much reporting going on and not delaying cases in the instances where we didn't need to. So what would be an amount that would, maybe looking at the last 5 years of cases, capture the top 2? Is it 80,000? Is it 120,000?
Is it that 70%?
It would probably be closer to looking at that 70% threshold, because even as time progresses, there's going to be changes to the value of the permanent disability. So we can establish a threshold today and have to come back to you a couple of years from now and seek more guidance. But if I was to pinpoint down to the 2 most expensive, they were in the mid 6 figures, like mid 150, 120 area.
So I would say maybe a hybrid number 4 that has a threshold value of 100,000.
Okay.
So that would include some at the 70%, some not. It would include things that kind of don't revolve around that. For example, I mean, God forbid, a death on the job would be kind of outside of that 70% permanent disability. So I think just having a round number like that. I like the idea of having the annual report. I don't know, would that be Mr. Samaria? Would it be the city attorney? Would it be you or all 3 that would do the annual report?
So the annual report that I would envision would be done by myself and my staff in closed session with some oversight from the city attorney to make sure that we're doing the Brown Act provisions accurately and correctly. But it would be mostly a staff report.
So that would be my suggestion, the number 4 with a $100,000 threshold.
Do you want to make that a motion?
Yes.
Any discussion to the, I guess first, is there a second to the motion?
I'll second it. I'm just looking for the combination of staff being comfortable with how we're going forward, as well as the comments that I'm perhaps colleagues more experienced in this arena than me on this issue.
Is there any public comment on this item? Okay, seeing none, I think it's back to the committee. And I'm comfortable with this option, this change, and would support the motion.
Great.
So all those in favor say aye.
Aye.
Aye. Opposed and abstained? None. I think that concludes our business today.
Thank you very much.
Thank you very much.